Hi folks, this is Dr. Jeff Camarda today with 4 things every bond investor, God help you if you're on one, every bond investor must know. Number 1, bond prices change with interest rates. When rates go up like they're doing now, just recently affirmed by the Fed, with more rates this far out as the forecaster can see, bond prices go down. When rates go up, bond prices go down. That trend is firmly established here in 2018 and beyond. This is because investors prefer to get paid higher rates, and if old bonds offer lower rates, they simply won't pay as much for them. They'll trade at discounts. That's how the bond market equilibrates for changes in interest rates. The longer before the bonds mature, the bigger this discount. Since rates are clearly going up and probably will for many years, if not the rest of your life, this is the single biggest risk facing bond investors today. Tip number 2, unlike stocks, fair bond prices are very hard to determine. Municipal and corporate bonds don't trade much and are generally only worth what a dealer is willing to pay. A dealer, like a car dealer or a car dealer. You generally can't look up a bond's price in the paper, and you really need to rely on your broker or your dealer's estimate of value, which can be often inaccurate for various reasons. And remember, dealers have to resell to other investors at a profit, so the price they pay a seller, you, when you want to get rid of it, is often less, sometimes much less, than the price they'll charge a buyer, which is often much higher than their own wholesale cost. So an investor, when he buys, will often pay a big price. When he sells, often get a much smaller price. And these spreads are still quite problematic in bonds. Tip number 3, there's a very clear trend that interest rates are increasing in the U.S. This means bonds that you own or may buy will almost certainly go down in value. If you hold to maturity, you'll still get lower value than market interest, so the loss won't be avoided. It's just not as obvious to you, but you're still losing money because your purchasing power is eroding because the interest rate's not keeping up with inflation. We don't think this is a good time to hold or buy bonds, if that wasn't obvious already, and suggest that you avoid them. If you have them, get rid of them. The longer you wait, the more we believe that you will get burned. And next tip, number 4, I think, not all bonds are safe bets. U.S. Treasury bonds are considered riskless in terms of default, but will still go down with interest rate increases. Again, you probably won't get stiff. The U.S. Treasury is going to pay the bond face amount at maturity, but it doesn't mean that you won't have purchasing power risk or the bond will lose value as it trades in the market before maturity. This default risk, a guarantee, this risklessness rather, is not the same though for municipal or corporate bonds, which do have significant default risk. Basically getting stiffed and not getting your investment back when the bond matures. While ratings are important to assess this risk, conditions and ratings change over time, and even bonds rated high, investment grade, best investment grade, AAA for S&P, for instance, they may not stay there. When the next recession comes, those bonds' ratings may slip, and some bonds may become worthless. High yield bonds, we used to call these junk bonds back when the financial word was maybe more transparent and more honest. Now high yield bonds say like, gee whiz, I'm just making more money because you're taking more risk. Junk bonds are at the greatest risk of this. Anyway, if you obviously you know how I feel about bonds. If you have or are considering bonds, get a free bond stress test from us to help understand risks and costs. Just click the link in the upper right hand of your screen or in the YouTube video description below and fill in the form where the link takes you for one of our advisors to follow up with you, get the lowdown on your bonds, and get you a very critical objective analysis of cost, risks, and so forth. Anyway, thanks for suffering through that. I'm Dr. Jeff Camarda, wishing you pleasant and cool midsummer. Until next time, thanks for watching.